Yesterday, the euro slid despite upbeat data on Eurozone GDP for the fourth quarter. The indicator remained stable, indicating that the euro area managed to avoid a recession. In the fourth quarter of 22, seasonally adjusted GDP increased by 0.1%, outperforming expectations for a 0.1% drop. On an annual basis, growth was 1.9%, beating expectations of 1.8%. This means that the European Central Bank will probably stick to its aggressive interest rate path in order to fight surging inflation, ignoring an ongoing decline in economic activity. The euro's reaction to the news was negative. However, it still managed to recoup losses driven by data from the United States. The Conference Board's Consumer Confidence Index came in at 107.1 in January, below consensus estimates of 109 and the revised December reading of 109. As for the British pound, the situation was similar. Before we get into technical analysis, let's take a look at today's macroeconomic calendar. It includes the final manufacturing purchasing managers indices for the euro area, Germany, and Britain. In addition, the euro area is set to publish data on consumer prices. Eurozone inflation rate is forecast to ease to 9% in January. However, this report will hardly have an impact on the decision the European Central Bank will take at the next meeting to be held tomorrow. Furthermore, traders may take notice of core consumer prices in the euro area. The core inflation rate is expected to be 5.4%, up from the previous reading of 5.2%. If the indicator meets or exceeds above analysts' forecasts, the euro will most likely gain value amid expectations that the European regulator will keep tightening its monetary policy. As for reports from the US, it's worth paying attention to data on non-farm payrolls and manufacturing activity. US non-farm payrolls are forecast to drop sharply, which may put pressure on the dollar. The final manufacturing PMI for January is anticipated to come in at 48.0, pointing to weakness in the US economy. The key focus of market participants will be on the Fed's decision on interest rates. This time, Fed officials are expected to approve a 0.25 percentage point increase, a more modest pace compared with earlier size moves in 2022. Moreover, if the US Federal Reserve announces the end of its tightening cycle, the greenback will come under stronger pressure. In this case, risky assets will rally. And now let's take a look at the 1-hour chart of the euro-dollar pair and consider it from a technical standpoint. In the first half of the day, a false breakout at 1.0874 will make it possible to open short positions, counting on a decline to 1.0839 and 1.0804. At the level of 1.0804, I recommend going long on a rebound with a view to catching an intraday correction of 25-30 pips. If the price forms a false breakout at 1.0839 or consolidates above 1.0874, the euro will have a chance of rising to 1.0909 and probably 1.0956. At these levels, it would be a wise decision to go short on a rebound, trying to make a profit on an intraday correction of 20-25 pips. Notably, all this is relevant until the US Central Bank announces its interest rate decision. Speaking of the British pound, bulls are currently trying to win back losses and push the price up to 1.2336. If the price rises above this mark and tests it from the top down, a buy signal will be generated. In this case, the pound sterling will advance to 1.2390. At this level, traders may go short on a rebound with a view to catching an intraday correction of 30-35 pips. If the price climbs to the next resistance level of 1.2444, it will also be possible to see the pair on a rebound. Alternatively, a false breakout at 1.2336 will create a sell signal, thus dragging the British pound down to 1.2284. If the price breaks through this mark, it will most likely extend losses to 1.2237. In this area, traders are recommended to go long on a rebound, counting on an intraday correction of 30-35 pips. Long positions at 1.2284 can be considered amid a false breakout. The more distant target of bears will be 1.2172. However, this scenario is possible only amid hawkish Fed comments. At the same time, given that the Bank of England does not intend to slow the pace of its interest rate increases, the pound sterling still has great upside potential. Best of luck!